Welcome to RenMac Off Script, where we're able to discuss markets, economics, policy, history, and life. It's the 12th of January, 2024. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account at RenMac LLC and our LinkedIn page. And if you like what you're hearing and you want some more insight, but you're not an institutional customer, then go to RenMac Access. It's renmacaccess.com, and you can catch up with the latest thoughts on the inside of what RenMac's thinking and how we're approaching the markets. Well, we're going to talk a little bit today about the CPI figures, the 1970s versus today, some of the government funding issues that we've got next week, the 2024 election, the improvements that we're seeing in healthcare, Bitcoin, and Chinese tech. But let's go with CPI because that is top of mind. It was an important data point. And I have to say, I've been in this business for 30 plus years now. CPI is always been, I'd say, top five, but certainly it seems to be more to the forefront of people's minds today than it has been in a long time. The headline number was a miss, but certainly the bond market reacted more in line with the kind of trajectory of the Fed, and certainly your thoughts, Neil. What did you take away from the CPI number yesterday?
Sure, thanks. So, remember that with inflation, like a lot of indicators, right? There's different measures to look at the same concept, in this case, consumer prices. And there's the CPI index, which is a very popular measure. And then there's the personal consumption expenditures deflator, which is what the Fed actually looks at. There are differences of weight between the surveys. So, things like shelter account more in CPI than they do in PCE. There's also differences of scope, right? So as an example, medical care services in the CPI, that only looks at out-of-pocket expenses. By contrast, in the PCE data, it includes payments made on behalf of individuals. So, third-party payment, Medicare, Medicaid. And that's important. And that's one of the reasons why the Fed believes that the PCE number is the better measure for underlying inflation. And I think that's maybe one of the reasons why the markets did what they did following that CPI number. You couldn't have laid out a better case for yields to go higher yesterday. It wasn't just the CPI number that was a bit firmer than expected. Initial jobless claims were lower than expected, so the labor markets look still quite tight. And yet, bond markets rallied. And this morning, we saw the producer price index data. And remember, the PPI data is important because some of the components within PPI are used as inputs in sort of the PCE tabulation process. But healthcare ran just 0.1% in PPI. So again, it was 0.7 in CPI, it was 0.1 in PPI. So that's going to grow the wedge between PCE and CPI. At any rate, when you do it all, tally it up, you looked at the inputs from CPI, PPI, and you try to make a forecast for PCE. PCE is likely to come in below CPI on core, maybe 0.2, could even be a little bit lower than that. And it indicates that core PCE inflation is likely to be below 3% by December. And so if you're the Fed and you're following this kind of rules-based framework, you're probably going to be revising down inflation again come the March FOMC meeting. So this is one of the reasons why. That feels like the trajectory that we're on. I would just add that used car prices actually rose in December in the CPI data. That's not going to happen going forward. There's a lot of momentum to the downside on used cars. We're seeing that at the auction level. So it's really just a matter of time. And so, as I say, the Fed's going to go into the March meeting, revise down their inflation forecast and reiterate what they're saying about rates. It seems kind of fanciful. So I think, my sense is that they'll cut in March. And I think that this supports that. And I think the markets are coalescing around that view.
Not to poke the bear here, but you're seeing a lot of, or at least a fair amount of people pandering to this idea that the Fed's helping the political process in 2024. And, really, it's just a matter of the data is driving the Fed here. And it happens, I'll be the first one to admit this, it happens to be more likely better for Biden than not. But there really isn't anything about the data other than kind of maybe taking the first blush about it that would imply that there's something nefarious or some type of conspiracy here between the Fed and the politicalization of the Fed. Do you see
No, I
anything?
mean, as you know, I think that this is mostly, I mean, I would just say that the people making that argument really fall into two categories, in my view. I mean, number one, they've been very bearish on the economy. They've talked about long and variable lags, and now the Fed's cutting, and they need the Fed to stay hawkish to justify their negative economic forecasts, which are now clearly wrong. The second is just more, obvious, which is people angling for positions on the chance that, Trump stumbles back into the White House. And, you're not going to get a job basically defending the Fed if you're trying for that. So, I mean, I think that's really, to me, how it's shaken down. As I said, I've been calling for a March cut for over a month. Maybe early November we started talking about it, and I didn't need politics to make that argument, right? And I would just say that the Fed has talked about in their summary of economic projections, they've had penciled in cuts since the middle of 2022.
Right.
Okay, they've had cuts. They've been thinking they would think, I mean, obviously everything's conditional, but even back then they thought that they'd be doing something, in terms of cuts in 2024. And again, like, go down the list, go down through all the G10 central banks. I mean, it's not just the Fed that's thinking about cuts. And a lot of those central banks are in countries that don't have elections next year. So, I mean, so I think it's kind of,
Yeah. The other thing
it's
too
sort of
that
the last refuge of the scoundrels,
the um the other thing too that I think is important, and again, we saw it in the bond market yesterday. You had a lot of reasons for the yields to pop and back up, and keep in mind this point in time, 2 3 weeks ago, we had an oversold condition in the 10-year yield. I mean, that by itself, within still an uptrend in yields, that by itself gives a lot of credence to some type of mean reverting rally. And strong markets, strong trends will respond vigorously to oversold conditions in those trends. And these yields have not responded vigorously to the oversold condition, which in a lot of ways that behavior tells you what's happening. And I think the other thing too that really gets misplaced or maybe just overlooked is the fact that there are real legitimate tops taking place in the bond market, particularly in Europe. I mean, most of the 50 days are below the 200-day moving averages in the yields and the 10-year bund, the gilts in France, etc. So this isn't just something that's happening in the U.S. In fact, I would say we are more bullish on bonds than what the chart would suggest because of what we're seeing globally and what that knock-on effect is. And by the way, the other thing that gets overlooked is just the number of indices globally that are in bull markets. The number of new highs or within 5% of a new high of the global indices is astounding, really, with the exception of China, Hong Kong. Most other indices are very, very bullish and breaking out. I mean, look, Japan's been in a bear market since I've been in this business. I got this business in 1990. It was at the peak of the Japanese equity markets. It has carved out a massive base, and it's just this really just this thing of beauty that you hardly ever see in real time and looks fantastic. Well, let's stick on the idea of 2024. I think barring some cataclysmic event, we're going to have an election this year. We do have Iowa coming up. Now, I did see Steve. I want to throw this at you and see what you think about this theory that I think it was the Department of Defense is creating this weather event in Iowa to impact the turnout of the caucusing so that they can skew the primary. What do you think about that? I mean, I love that. For the creativity of it in and of itself, I love that idea.
I'm not sure I've seen that analysis, but you do have a point in that obviously the weather will impact turnout. But I think near zero temperatures in middle of January, I don't really see that as extreme in Iowa.
And not for cold-hearted Republicans too, right? I mean, they're all used to that.
Probably not, but I think the thing to watch that may be more impactful beyond false weather conspiracies would be the fact that Chris Christie dropped out. Now, granted, he did not have much support in Iowa. Clearly, I think the intent, besides recognizing the fact that he has no way forward, is to try to bolster the case of Nikki Haley to become the Trump alternative. She still has a lot of momentum. Some polls that have been more recent show her gaining some ground there on Ron DeSantis. So I don't think there's any question of the outcome in Iowa. I think you have to watch the margin of Trump's victory. But, this sort of showdown for second place, whether Haley can sort of build that momentum heading into New Hampshire on January 23rd, I think a lot of people are going to watch, as well as, Trump's margin. Is he above 45%, maybe above 50%? That suggests he's very strong. If he's, again, maybe more of a narrow victory, does that sort of signal concern that maybe, the polls are indicating that he's maybe stronger than he actually is? Keep in mind, though, that even if Haley comes in second or a very narrow loss to Ron DeSantis and DeSantis gets out, you know, more states after New Hampshire are going to resemble Iowa because New Hampshire has a lot of independent voters because you don't have to be a registered Republican to participate there. You also have a high concentration of college-educated voters. So the challenge for Haley, again, if she wins New Hampshire, I'm not convinced that she will, but if she does, I don't think she's going to be able to win her home state of South Carolina. And that occurs right before the March 5th Super Tuesday contest. So I don't really see how she has a path beyond that. So that's sort of the thing to watch, I think, heading into Monday.
Well, before that, we have something important this weekend, another election, which is in Taiwan. What are the implications of this? How important is this to China? And what is kind of the response that we should expect given the anticipation of the outcome?
Well, sure. I mean, Taiwan's a relatively small country, I think of around 25 million people, but it takes on outside significance because it's the major flashpoint between the world's two superpowers, the US and China. From a market perspective, the US is still dependent on Taiwan Semiconductor Manufacturing Company for its sophisticated chip needs. So any blockade or direct confrontation could put US access to those at risk. And obviously, if you're betting on some big AI advance, that's not going to be easy to achieve without those TSMC chips. And then you get into just US weapon suppliers providing the ruling party, the DPP party, with a lot of weapons meant to deter China from seizing the island. If you see a change in control at the presidential level, then you're going to put those US continued arms sales to Taiwan at risk. I think when you talk about how Xi is going to react, Xi Jinping, Chinese president, for those who I don't know how you wouldn't be aware of that by now, but if you're not, clearly doesn't like the ruling DPP party, which is associated more with the pro-independence wing. He's backing the KMT candidate, which has a more sympathetic view to China with the idea of sort of de-escalating tensions between the two sides by pursuing warmer relations. I think if the DPP wins, which polls suggest they will, now there's a reason for caution for polls because Taiwan law doesn't allow any to be conducted 10 days prior, but most polls had the DPP.
It's okay. We don't either here in the States.
Yeah, that's true. We have our own polling problems here. But we also have third-party threats, and that's actually occurring there in Taiwan, where you're sort of splitting the opposition DPP vote. So right now, everybody's betting that the DPP will stay in power, which, based on sort of the Pelosi precedent, suggests that China is going to respond with an aggressive military and economic response. Because of that precedent, people are anticipating, I think, that the military response will be greater than before. And that sort of gets into this question of when you start doing those things, is there a risk that some unintended consequence might spill into a more direct confrontation? And I think that's the fear. And then we have just resumed military to military communications. Those have been pulled in the past. You could question, given Lloyd Austin's sort of MIA, not in the White House, not knowing the defense secretary's whereabouts for several days, not clear whether he's in the hospital still or not. If China does pick up the phone, is there going to be on the U.S. side to receive the call? At the minimum level, it's a question of judgment on Austin's behalf.
I mean, you
But
can
I
just
digress.
text, can't you? Why wouldn't you just text? I can't stand calls anymore. Just text me. For God's sakes, it's a lot easier. Well, the one thing that stands out to me about, China and tech, I mean, there's a downtrend in places.
China.
Yeah. there's a downtrend in place in the Chinese tech market and the Chinese market overall. But it's interesting because correlations globally historically are pretty high amongst sectors and industry groups. It makes sense, right? I mean, if pharma is rallying in the US or pharma is rallying in Europe, it tends to rally in Japan, it tends to rally globally. But that's not happening in tech. Obviously, tech still looks very, very strong here in the US, and it looks weak in China. So, it's just kind of a sober reminder that technology can be a two-way street. I know there's policy differentials, but there's also a lot of blue sky thinking when it comes to tech, particularly with the billions of people that are end users of technology in China that can kind of create this optimism. But it's a pretty clear downtrend. Neil, just I wanted to ask you something because we put it on Twitter, but uh, we've seen some comparisons between the CPI, kind of call it a 15-year look at CPI back in the 1970s into the early 1980s, and somebody dual scaled this. It's a prominent figure, used to be a Treasury Secretary, but dual scaled it and overlaid today's CPI with the idea that we're about to trough out and then reaccelerate as we did back in the late 1970s, early 1980s. Now, whenever you dual scale something, it is the kind of the snake pit of charting and forcing data to fit your conclusion. But the other thing, that we added, which wasn't put in there, was what the Fed had been doing in the 1970s, which was really cutting rates before the peak of inflation, and kind of letting the tail wag the dog, if you will, and that's not happening today. What is your sense of the parallels between today and the 1970s for those who are worried about the 1970s analog?
I mean, it's a great question. I mean, I think that there are some similarities potentially. I mean, obviously, we're seeing what's going on with what's happening in the Mideast with these Houthi rebels, mucking up shipping lanes. And, I mean, part of what happened in the 70s, frankly, was just bad luck. I mean, you had a lot of supply chain disruptions, right? Like the Arab oil embargo. And, as these supply chain disruptions happen, it undercut longer run inflation expectations, and that over time became embedded in the system, and it became a huge problem. So that's something that we're keeping an eye on. Of course, at the same time, this also weighed on productivity, right? Like if you have persistent supply shocks, that weighs on productivity over time, which is also unhelpful to kind of quell inflation. So those are some of the similarities. Of course, the key difference, I think, is that the Fed funds rate is well above core inflation. I mean, believe it or not, core inflation is below 2% on a 6-month basis already. And you weren't really seeing that in the 70s. And of course, we have history as an example, right? I mean, the Fed knows what to do if inflation really starts to get out of control. And as they've shown, they have no problem doing that. So I think the fact that we've gone through it once, I think, is one reason to expect us not to go through it again. Kind of learning from past mistakes. But I would just say that unlike that period, I mean, the Fed funds rate's at 5.5%, and core inflation is at sub 2. I mean, you didn't really have real funds rates that high back then. So
Right.
that's important to keep in mind, and I think goes to your point.
Well, the other thing that I think, and this is like so big that people miss it, right? I mean, keep in mind that in the mid 70s, we were coming off a global monetary system that was based on a quasi gold standard, right? I mean, and you just kind of unanchored that, and it was the Wild West all of a sudden, right? So everybody was trying to, kind of come to grips with how do we handle this without this anchoring effect of gold. And I would actually argue, I mean, there's no evidence of it yet, but one of the things that is a concern, again, because it's so big, we talked about Japan before, is that if we've got a shift from the BOJ, I mean, they've been doing nothing but providing global liquidity for the last 30 years. So everybody that's been in this business is just kind of used to this persistent ramp of liquidity being provided by Japan. And if they're going to start to shift that and bring that back, I don't think any of us know exactly what the ramifications are, the impact are of a tighter BOJ that's not pumping liquidity into the world. So in many ways, from a big, broad macro of all macro perspectives, you might have the differential being the unhinging of a rigid and inelastic monetary supply system back in the 1970s, going to full elasticity, and today going from full elasticity to something that's a little bit more, sobering and consequential from a liquidity standpoint. I don't know if that's happening, but I do think that what we're seeing in those parallels just is off base. So we'll continue to watch it, but nothing going on there. So 2024, or actually in the fourth quarter of 2023, we talked about healthcare and what we thought was this really great opportunity from a contrarian perspective, from the risk-adjusted returns that we'd seen over the last several years in healthcare, from the ETF outflows, which is obviously people giving up on the space. As listeners know, we are contrarians. We are chart followers. We look for those opportunities that might not fit some narrative. But what you really want to do is use that and then build into those things as you're getting confirmation or affirmation from the markets. And I'd say over the last week, and this is global in nature, we're seeing a lot of what we call golden crosses in healthcare. That's the point at which the 50-day crosses above the 200-day moving average on a lot of individual names in healthcare, just absolutely fitting that script, if you will, and that path towards some type of meaningful improvement in the space. So still very comfortable with that healthcare call for 2024 and what we're seeing. The other thing that I think is interesting and certainly notable, we're not big devotees of Bitcoin or crypto, but obviously the SEC ruling now allowing crypto to be a part of the ETF families, if you will. And I think that's important. I mean, we went back and looked at what happened to gold back when the GLD was first introduced back in 2004, 2005, I believe it was. And what's interesting is it tamped down the volatility of gold, so that would be welcome for Bitcoin. But it also just kind of created this new accessibility, right? And I've owned gold or the GLD, gold through the GLD off and on for the last 15, almost 20 years now. And it was really a function of, being able to have access. Had I had to go out and buy gold coins or had to have all that friction, of owning gold in some other capacity, which was expensive, and frankly, a pain in the neck to do, it just wouldn't happen. So I think this is a meaningful shift in terms of creating an asset class and making Bitcoin more accessible. And even though the history of GLD and gold, by the way, gold kicked off a massive bull market right at the point where the ETF came out. So I think you can get this long consolidation. I think there's probably a lot of anticipation of this, but certainly I do think it goes a long ways into the legitimization or at least the accessibility of Bitcoin as we go forward, and crypto more generally. So, Steve, any thoughts on that from the SEC? Do you have any insight from their decision?
Well, I think it'd been telegraphed for a while after SEC Chair Gary Gensler lost the grayscale case. Was sort of notable to me was when you looked at the vote, the other two Democratic commissioners actually voted against the approval. So it was Gensler recognizing the legal situation that he was in. He had to write a very reluctant statement approving it, went out of his way to say that, this was not an endorsement of Bitcoin, that there was still a lot of risk associated with it, but just chalk this up to another long list of losses for Gary Gensler right now. And, we'll see if this is sort of having some impact on the SEC when they're considering this sort of climate disclosure rule. It's been delayed for a long time. Another legal setback, not a good look for him. And then you start thinking about, if Biden does win, do people like that sort of exit? I think that's sort of, we get closer to the election, some things to consider about, personnel is policy. But those are the things that sort of jumped out at me.
Neil, what's on the docket next week in your world for data?
We have retail sales. That'll be the main event, I think, in terms of the activity data. Control sales are expected to be up just 0.2%. But remember that retail sales are nominal. So the fact that core goods inflation is moderating suggests that real sales are picking up. We already saw that with the unit auto sales numbers, which was better in December. We'll also be watching some of the housing data. So we get starts and permits next week. And consumer confidence. you know, I mean, consumer confidence has quietly been improving over the last few weeks. I mean, which makes sense, right? Rates are down, stocks are generally up, gas prices are low, labor markets are okay, so it kind of makes sense. So we'll see how that shakes out. That'll be at the end of the week.
Well, and the Lions are in the playoffs. I mean, there's another big boost of consumer confidence right there for the 600,000 people that still live in Detroit. We're the Giants.
Where are I mean, we're on a. They had a. I think they got the what number 6 draft pick. Although I did see this funny. It's I don't know if you saw this. So obviously Bill Belichick is out as Patriots coach. I think after 20-something years, and the NBC New York 4, our local news, had this to say on their Twitter account. Bill Belichick, who lost 2 Super Bowls to the Giants, expected to part ways with the Patriots later today.
That is great.
And then they showed previous things where, okay, so when it's so then they had Tom Brady, who lost 2 Super Bowls to the New York Giants, divorces from wife. It's just great.
So
Anyway, playing to their audience.
Indeed. Steve, what are you watching out of the primary next week, and what are you watching out of the funding?
Well, in terms of the primary, again, it's going to be that order of finish and Trump's margin. And sticking with the theme of playing to your audience, it's going to be the pressure on Speaker Mike Johnson, who last week seemed to, I guess, re-agree to the initial deal from Biden and his predecessor, Kevin McCarthy, although that clearly upset a lot of the same House conservatives that ousted McCarthy, in large part because of that deal. So now he's sort of contemplating whether or not to renege on that agreement. And that's creating a lot of uncertainty around next Friday's government funding deadline. Now, keep in mind, that is for 4 of the 12 appropriations bills. That's about 20% of government spending. So you're talking about the potential economic impact of a partial government shutdown. That would not be that significant. We already see Senate Majority Leader Chuck Schumer clearly got the better of Johnson on that spending deal, looking to jam him again by seeing if the Senate will move forward with a continuing resolution to avoid that government shutdown. And Johnson did himself no favors by inexplicably saying that he was not going to support short-term CRs after he needed to move one in November. So now he's really boxed himself in. And I think it's just raising a lot of concerns amongst House Republicans. There's a lot of pressure to remove McCarthy. Was the guy replacing him going to be an upgrade? And I think, at least amongst some, there's reason for doubt right now. Not that I'm necessarily a McCarthy supporter, but decisions have consequences.
Yeah, I mean, when you take a step back, and for anybody that's independent out there, you might not like the policies of what's going on right now in the White House, but when you look at the alternative and you start to say, is this dysfunctional or not? I mean, that's a big deal. You want stability. Maybe if you don't agree with the policies, but you have stability, you probably stick with stability just because it's got that overarching sort of sense of continuity to it. And the mess that is Congress right now, you just have to wonder how the independents really feel about that.
I agree. And I think that's sort of the challenge. Republicans already have a difficult map in the House. Again, there's 18 Republicans from districts that Biden won. You've had a lot of court rulings in favor to Democrats to draw more districts. You've had a lot of Republican retirements. So doing this just sort of does not help your odds, in my opinion, of keeping that majority, because it's going to depend on winning a lot more moderate races. To your point, independents being sort of tuned off by this. And then just politically, look, I mean, you have a 2-seat majority now, and you control the House, but Democrats control the Senate and the White House. That's just the political reality. So what are your expectations here? Not to mention just shutting down the government. Why do you want to keep the attention away from Hunter Biden and his contempt of Congress charges and just sort of the southern border crisis that continues to get worse day by day? Again, that's just how I see it, but we'll see what happens.
As I tell my kids, get your together. All right. Well, we're going to be watching the continuation of the improvement in healthcare. The market's still in a bull market. If we look at the breadth is still very, very good, very 1995-esque. We actually think we've got pretty good a pretty good runway into at least the first Fed rate cut, which Neil suggests is sometime in March, and seems to be also what the futures market suggests as well. So still on that trend, looking for opportunities, particularly with healthcare, to be adding to those on these breakouts. Join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter. And if you like what you're hearing, you want deeper insight, but you don't have the institutional dollars, join us at RenMacAccess.com. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
Go Lions. We'll see you.